Hey everyone, welcome to this explainer. Today, we're pulling back the curtain on something that is honestly one of the most high-stakes, adrenaline-fueled moments in the financial world. We're talking about the mechanics of the payday. It's that hidden plumbing of global securities operations that creates a literal ticking clock behind every single transaction. Let's dive right in.
So, where is my dividend? I mean, we've all been there, right? You're sitting at your computer, refreshing your brokerage account, just waiting for that promised cash to finally arrive. It's an incredibly relatable experience. But while you're simply waiting for a digit to update on a screen, the financial ops teams behind the scenes, they are navigating this massive high-pressure maze of funding, risk, and reconciliation just to make that happen.
To really get a handle on this maze, we first have to pin down the exact definition of the pay date. Often called the distribution date, this is the specific date the issuer or their paying agent actually dispatches the distribution to the owners of record. Now, you've probably spent weeks tracking the initial announcement, making sure your position is right on the record date, and safely navigating the X date. The pay date, well, it kind of looks like the finish line. But as we'll see, it's actually the moment of maximum pressure for the back office to ensure the market's plumbing doesn't spring a leak.
To ground this complex technical concept, let's just think of the pay date like your standard direct deposit payday, right? Your employer calculates your hours weeks in advance. That's basically your record date. But the actual transfer of cash into your bank account happens on a specific Friday. Now, imagine if your bank credits your account the very second the clock strikes midnight. They're giving you the money even if they haven't technically received the wire transfer from your boss yet. How on earth do they do that? Well, that brings us to a really crucial distinction in how brokers handle this massive influx of cash. Look, in a perfect world, trillions of dollars would just move simultaneously across the globe, smooth and easy. But in reality, brokers handle this last mile of the trade in two completely different ways, and it all depends on their service level agreements, or SLAs. On one side, we have contractual settlement, which is basically that midnight credit premium service. And on the other, we have actual settlement, which is the risk-free, cleared funds route. Let's break these down to see exactly what's going on under the hood. Starting with contractual settlement. This is something often offered by top-tier brokers as a premium service for their clients. Essentially, it means they credit the client's account instantly on the pay date. But here's the kicker. They do this regardless of whether the cash has actually arrived from the custodian yet. It's exactly like that bank advancing your paycheck at the stroke of midnight. It's absolutely fantastic for you, the client, because the liquidity is immediate. But it creates a pretty wild dynamic behind the scenes. Then there's the stark alternative, which is actual settlement. This is the completely risk-free route for the broker. If a broker uses this method, well, they make you wait. You are not getting your dividend until that transfer from the issuer is 100% confirmed, and the cleared funds are safely locked in the broker's vault. There's no guessing, there's absolutely no advancing of funds, and there's no midnight credit. It's a much safer route for the institution for sure, even if it means investors have to tap their fingers a bit longer. So this begs a really crucial question. What actually happens if the issuer is late? If a broker is operating on actual settlement, it's just a delay, no big deal. But if a broker has promised contractual settlement, if they've already credited millions of dollars to client accounts at midnight, and then the issuer's cash just doesn't show up, suddenly we've got a massive conflict on our hands. We hit what the industry calls a funding gap, and it is literally one of the hidden dangers of modern financial ops. Here's exactly how that danger plays out step by step. Step 1, the broker credits the client account, fulfilling that premium service promise. Step 2, the custodian or the issuer fails to deliver the funds on time. Now the broker is officially at risk. They've just handed out cash they don't actually possess yet, which forces Step 3. The broker has to fund that payment using their own reserves. They're often frantically borrowing funds from their own Treasury department just to cover the shortfall. And as you might guess, borrowing from the Treasury isn't exactly free. It introduces a terrifying reality for ops managers: costly overdraft interest. When a broker is forced to cover a late, multi-million-dollar transfer right out of their own pocket, they start bleeding money. The financial penalties and the overdraft interest can accumulate at an absolutely astonishing rate. This is exactly why the back office isn't just some room where paperwork gets filed away. It is a real-time risk management center protecting the firm's entire bottom line. To survive this daily marathon, operations teams are just constantly racing against the clock. In the morning, they start out with what we call projected entries. These are essentially highly educated guesses about what cash should be arriving, based on the prior announcements. Then, as the afternoon rolls around, confirmations slowly start to trickle in from central securities depositories, or CSDs, and custodians. Finally, by the end of the day, the ultimate goal is to convert those projections into settled entries, turning those educated guesses into hard reality. But what if reality doesn't match the projection?
Well, that brings us to a term that genuinely keeps back-office workers up at night, a reconciliation break. This happens when the general ledger doesn't match up to the very last penny. Imagine if a projected entry was, say, $100 million, and only $99 million actually cleared. That mismatch triggers an immediate, frantic hunt for the missing money. They have to figure out exactly where the pipeline leaked, and they have to do it before the end of the day. And the most dangerous part of all this is how quickly the pain escalates if they don't find that money fast. Consider the compounding cost of interest claims over just 1, 2, and 3 days of a failed settlement. Being even a single day late on a massive payment scales up the risk exponentially. If the firm owes money to another party and fails to deliver, they get hit with these incredibly costly interest claims from clients. The longer that break stays open, the steeper the risk climbs. It's a literal race against the clock. So, all of this brings us to one undeniable truth. The pay date isn't just about money moving from point A to point B. It is the absolute ultimate test of operational efficiency and market trust. It's the exact moment where weeks of complex announcements, record date calculations, and corporate actions finally transform into actual, tangible investor liquidity. It is this massive, invisible machine making sure a promise made weeks ago becomes cleared cash today. And to keep this massive, invisible machine from just spinning out of control, it relies on a very strict governing framework. You got international standards like ISO 2022 dictating specific messaging formats on a global scale. You have strict, constantly changing market regulations that vary by jurisdiction, and, of course, those service-level agreements we talked about earlier. All of these pieces have to work in perfect harmony to keep the global financial system functioning smoothly. So, next time your account balance magically updates at the stroke of midnight, will you wonder who's actually fronting that cash? The next time you see a dividend appear, you'll know exactly what's going on in the background. You'll know about the daily marathon from projected to settled entries, the critical difference between actual and contractual settlement, and the incredible high-stakes infrastructure powering your own personal finances. Thanks for joining me on this explainer, and definitely keep questioning how the financial machinery around us really works.